Welcome to the Explainer. Today we're tearing down the architecture of a bank that doesn't really exist, well, at least not in the physical world. Imagine a global banking powerhouse with absolutely no CEO, no teller windows, zero loan officers, and no headquarters. You deposit funds, and the system automatically pays you interest. You want to borrow? The system instantly checks your collateral. Every single rule is written in code, completely transparent for anyone to verify, and literally impossible to quietly change behind closed doors. That's Aave, the decentralized protocol we're dissecting today.
Just to wrap our heads around the sheer scale of what we're talking about right off the bat, consider this number. Since it launched, Aave has processed over $775 billion in cumulative lending volume. To put that massive figure into perspective, it makes this purely code-based entity comparable in size to the 37th largest traditional bank in the entire United States.
So, here's our roadmap for this explainer. 1. The decentralized bank. 2. The mechanics of liquidity pools. 3. Inventing the flash loan. 4. Reshaping DeFi security. And 5. Governance and evolution.
All right, jumping right into Section 1, the decentralized bank. This is where code becomes the ultimate regulator.
Think about your standard traditional banking setup. It relies on a heavy, slow layer of human middlemen, right? When you deposit money, a human loan officer has to review the next customer's credit score. Regulators have to oversee the whole process, and the bank, naturally, pockets the massive spread in between. Aave cuts out the middleman completely. It turns that entire clunky process into transparent, unstoppable code. Depositors put assets into a smart contract liquidity pool, and borrowers interact directly with that exact same pool. There is zero manual review. The code is the only rulebook.
And honestly, you really can't argue with the results. As of mid-2025, this code-driven approach commands roughly 60% of the entire decentralized finance, or DeFi, lending market. We're talking about over $43 billion in total value locked, spread out across 14 different blockchains.
Which brings us to Section 2, Mechanics of Liquidity Pools. Let's look at the dual-sided engine powering all of this.
Let's say you're a supplier. We'll call you Alice. The process for Alice is incredibly frictionless. She deposits 10 Ethereum into the protocol and instantly receives a ETH in return. You can think of these as interest-bearing receipts. But here's the coolest part. That token accrues interest automatically. Alice can literally open her wallet and watch her balance tick upward every single second. Plus, unlike a traditional certificate of deposit, there are no lockup periods. She can yank her funds out whenever she wants.
But what about borrowing? Since Aave doesn't run a credit check, how do they know you're good for it? Well, they rely strictly on a concept called over-collateralization. Basically, if you want to borrow $1,000, you have to lock up significantly more than $1,000 worth of assets to guarantee the loan.
Let's run the exact numbers on how that plays out. Say Bob deposits $3,000 worth of Ethereum as collateral. Aave allows a maximum loan-to-value ratio of 80%, so Bob can only borrow up to $2,400. But crypto is volatile, right? If the market dips and Bob's collateral value drops to the 82.5% liquidation threshold, the protocol acts ruthlessly. Anyone on the network can jump in and liquidate Bob's position to pay back the debt, and they even earn a 5% penalty reward for doing it. It sounds harsh, but it completely ensures the decentralized bank stays solvent without ever needing a collections department.
Okay, shifting gears to Section 3, Inventing the Flash Loan. This is a true blockchain primitive.
This is where things get wild. A flash loan is a financial tool that literally cannot exist in traditional finance. It allows a user to borrow any available amount of capital from the pool, even hundreds of millions of dollars, with absolutely zero collateral. None. The catch? You have to borrow the funds, use them, and repay them all within the exact same Ethereum transaction. If you fail to repay it, the protocol automatically reverts the entire transaction like it never even happened.
Because blockchain transactions are atomic, meaning they either go through 100% or fail 100%, you have roughly 12 seconds. That's the time it takes to validate one Ethereum block. In that 12-second window, you borrow the funds, execute your trading strategy, and repay the loan plus a tiny 0.09% fee. If you mess up, the network pretends the whole thing never happened. The lender never actually takes on a single ounce of risk.
Aave's founder, Stani Kulichov, really hit the nail on the head when he said, "Flash loans are the first financial primitive that can only exist on a blockchain." It completely rewrites the rules of capital efficiency, because suddenly you don't need to be a billionaire to trade like one. You just need a profitable strategy and a few bucks for network fees.
Let's look at a real-world scenario to see how crazy this is. An opportunistic trader notices Ethereum is priced a bit cheaper on Uniswap than it is on SushiSwap. They use a flash loan to borrow $1 million with zero collateral. They buy the cheap Ethereum, instantly sell it on the other exchange for a higher price, get their funds back, repay Aave's loan plus that small fee, and net over 15 grand in pure profit. All of this in 6 steps executed flawlessly by code in 12 seconds.
Moving on to Section 4, Reshaping DeFi Security. Let's talk about what happens when capital is infinite.
Because naturally, infinite capital is a double-edged sword. Flash loans removed the massive financial barrier required to manipulate markets, which inadvertently armed a whole new generation of attackers. In 2020, hackers used them to manipulate BZX's price oracles. In 2022, an attacker borrowed over $1 billion in stablecoins just to temporarily buy enough voting power to hijack the Beanstalk protocol, walking away with $182 million. And in 2023, the Euler finance exploit saw an attacker use $30 million borrowed dollars to loop an exploit that stole $197 million. Now, it is absolutely vital to note that Aave itself was not hacked in any of these incidents. Aave just provided the limitless temporary ammunition the attackers used to exploit flaws in other protocols.
Actually, Aave's own security record has proven to be incredibly resilient. Sure, they've had a few minor hiccups. There was an Oracle delay during the Harmony Bridge failure that created some bad debt, a V2 vulnerability that was swiftly contained before anything bad happened, and a tiny $56,000 exploit on a peripheral contract that the founder essentially likened to someone raiding the protocol's tip jar. But the core lending architecture? It's basically a fortress. Their intense focus on security has kept tens of billions of dollars completely safe.
And finally, Section 5, Governance and Evolution. How exactly do you upgrade a machine like this?
Well, there's no corporate boardroom. Instead, the people holding the Aave token dictate the entire future of the protocol. Through decentralized voting, they decide on everything from what new assets to list to tweaking risk parameters. And it gets better. Holders can actually stake their tokens in a safety module. This acts like a massive insurance layer. If the protocol ever did somehow incur severe bad debt, those staked tokens get slashed to cover the losses, ensuring the bank stays totally solvent. It's built-in accountability.
And this community moves fast. Just look at this timeline. From inventing the flash loan in V1 back in 2020, they pushed right into V2 with collateral swaps. Then V3 brought cross-chain deployments and isolation modes to handle riskier assets safely. And now, with version 4 in 2025, they are pushing the boundaries yet again, integrating fixed interest rates and real-world assets. The machine literally never stops upgrading itself.
So over 7 years in, Aave has completely stress-tested the entire industry. They've proven that a bank operating without human intervention isn't just a fun experiment, it's capable of securely handling hundreds of billions of dollars. Which leaves us with a pretty profound question to end on. As traditional banking systems continue to struggle with human error, bias, and massive inefficiencies, is this merciless, fully transparent, code-driven model the inevitable destiny of all global finance? Thanks for joining me on this explainer, and I hope this deep dive gave you a whole new perspective on the future of money.